coronavirus outbreak has triggered some historical price movements in major asset classes like stocks, bonds, and commodities. And here to help us make sense of it is John Love, CEO at USCF Investments. John, welcome to the show. It's great to have you with us.
Thanks, Lynn. Thanks for having me.
Oil has experienced some tremendous moves in 2020. In a research piece titled Crude Oil, Counting the Days, you wrote about the biggest daily moves in the price of crude oil. How does 2020 compare? Can you give us some context about how this year's move in crude prices compares to history?
Sure. Well, there's probably two ways to put it in context best. The first is, if you look at crude oil futures, which started trading in 1983, and you basically, we've got 40 years of data. So over all that time, there's only been 5 days when crude has moved more than 20% in a single day. Now, one of those days, you wouldn't be surprised, occurred during the 1991 Gulf War when hostilities broke out in January. The other 4 occurred in the last month. So it's just been off the charts, unbelievable volatility. We've never seen anything like that. When we looked at these kind of moves last year, we were looking to see how rare they were, how often they happened, that kind of thing. And stunningly, we've had 4 in a month, and not just moves of that size, but moves of great magnitude in the teens, well above 5%. So it's pretty stunning. The other way to look at it is, returns like this, volatility like this tends to cluster. So again, if you go back to the Gulf War, you tended to have a lot of returns in both directions around that time, and then volatility settled down and things kind of run along the average. And then they blow up again in the financial crisis, and again in 2014, 15, 16, when we had the oil crash at that time. So you look at those clusters, and then you look at now, and you see we kind of seem to be forming another one of those periods. But the difference is, again, the magnitude of the extremes, both on the upside and the downside. We've never seen a cluster of volatility this intense, and it's really stunning to look back at history and compare it.
USCF manages the U.S. Brent Oil Fund, ticker BNO, and the U.S. Oil Fund, USO. Both products use different crude oil benchmarks. What are some factors that can help an investor or trader decide which among these two oil ETFs to use?
Well, first of all, Brent oil, which is based in the North Sea or benchmarked to North Sea oil, a couple different grades there. It used to be seen as more of a global benchmark. So when events happen in the Middle East, things like that, it would affect Brent more than WTI, which used to be more of a U.S.-based benchmark, and it would depend on U.S. factors because we didn't export oil. Nevertheless, they are highly correlated to each other. The correlation has just increased a little bit since we've been exporting oil over the last couple of years. So for starters, you get a lot of similar moves. When one goes up, the other's likely to go up. But there can be differences. Just for example, a few weeks ago, there was a day when oil was down, WTI was down 24%, Brent was only down 13%. On the other side, you had a day where WTI was up a lot, Brent wasn't up so much. I think then the main difference that people want to look at is there may be different factors for why one might perform better than another, and you've got to look at all the fundamentals. But one of the key things I would look at as investors is, what is the shape of the futures curve? Is it in something called contango? Contango can be is basically a headwind against your return. A lot of times Brent or WTI, one will be in contango, the other could be in the opposite condition, which is called backwardation, which is a benefit. But when those spreads are different, I'd probably want to look at the commodity that maybe has a bit less contango or is in backwardation, because it gives you a little bit more of a boost to your return. So I think comparing those two, and you can go on the CME website, look at the futures contracts and see the differences right there.
Getting diversified exposure to major asset classes is still an important goal for portfolio managers and financial advisors. And the U.S. Commodity Index Fund, ticker USCI, does that. Tell us more about USCI and how its underlying index works.
Sure. USCI is the basic idea there is that when you look at commodities, you have a lot of different drivers for different things. So crude oil, cotton, cocoa, there's no reason they have to move together. And so it helps to diversify in any asset class or among asset classes. And the same is true of, maybe even more so, of commodities. But one thing that we kind of feel with USCI and the index it's based on, SDCI, is you don't necessarily want to own all commodities at once. You want broad exposure, but there may be a time when you want to focus on certain sectors, or you want a little bit less exposure to sectors that are in danger. So we have a rules-based methodology that basically looks at two market signals that have been predictive of outperformance over time, and we hold those. And the idea is that on average, hopefully, we'll do a little bit better than just sitting in a basket of commodities without ever reweighting it. And so that's pretty much the idea of USCI, is not only be diversified in commodities, into commodities, but also among commodities, maximize that diversification and take advantage of those that historically may have opportunities for better outperformance in the future.
Global governments are fending off the economic damage caused by COVID-19. And with trillions of new spending being pumped back into local economies, what do you think it'll mean for manufacturing and industrial metals like copper?
Yeah, I think it's hard to say right now, and I know a lot of people are making that assertion, and it's kind of frustrating, but there's just a lot of uncertainty out there. If you look, one encouraging sign, you look at the PMIs coming out of China after they put people back to work, and there was a very sharp V recovery in manufacturing. Copper, industrial metals in general, but especially copper, they're very, very tied to manufacturing. They're very, very tied to China. So that is an encouraging sign. Another thing I think we can look at is that industrial metals, copper again especially, tend to recover early in a market cycle. So when you've had a downturn and people are getting back to work, sometimes certain commodities like industrial metals can recover even before equities do, or alongside equities. So, I don't know when it's going to occur. I don't know if we're going to have, multiple shutdowns, or if we're going to have, this kind of soft and steady restart. But whenever it does occur, that's usually a bullish factor for industrial metals.
Okay, one final thing before you take off. It's easy to get wrapped up in the emotion of crashing prices, but panicking is not a strategy. What do investors and traders need to remember during times like now?
Well, even professionals need to be reminded not to panic. It's very difficult when, even when you've been through these things before, you see prices crashing and you hear the worst news out there, and you kind of have to be aware of it, but not let it affect your emotions. You're absolutely right. You don't want to panic. And I think the easiest way to do that and also maximize your outcomes is to diversify. Don't panic when it goes down. Don't sell when it's low, but be diversified. Be diversified among asset classes and be diversified within asset classes. And that way, a lot of things might go down at the same time, but you can be confident that over the long haul, what you've got, things will perform differently at different times, and that hopefully will kind of even things out. So I think diversification is the golden rule, and that means stocks, bonds. It also means a little commodities and maybe some other things depending on your knowledge of different asset classes. So diversification is my keyword for the day.
John, thank you so much for your insight and for stopping by. You just heard from John Love, CEO at USCF Investments. I'm Lynn Dolan with ETFguide. Be sure to subscribe to ETFguide TV and post your comments below this video. Thanks for watching.